Well, just their headline, Matt, multifamily rents advance as economic doubt swirls. That's kind of what we've been talking about all day, all this economic doubts. Let's move on from the economic doubt. We know what that's like. But they're saying demand's remaining firm. The first bullet point, multifamily rents rose slightly in March. The average U.S. asking rent rose $3 in March to $1,706. Year-over-year growth fell to 4% nationally, 90 basis points less than from February, and the lowest level since rents started an unprecedented climb in April of 2021.
Yep.
Next, although financial markets remain volatile due to the collapse of several banks, multifamily property fundamentals are stable. Rents in the national occupancy rate were unchanged during the first quarter of 23, and 21 of the top 30 Matrix metros recorded rent gains in March. The third and final point is single-family rental rate increased in March by $5 to $2,079, while the year-over-year increase fell by 80 basis points to 2.8%. Occupancy also decreased 10 basis points in February. Matt, it's still early. I think it's still early, but we are seeing some signs. I mean, just looking at this graph, you can see the dip, you can see the plateau and the slowdowns, and now a little bit of a lip up again.
Yep.
It's like promising, but I think there's a lot of wood to be knocked.
Yeah, and there it's a market by market difference too. Is pretty sharp here, and there's a lot of big markets that are down that may be pushing the national average down a little bit because you're looking at Indianapolis, Kansas City, and New York actually. All of them around like 7%. That's far from the 4% average.
Yeah, the national average is, there's only a handful of metros that are really above the national averages, Matt. To your point, there's such a big disparity right now between the top and the bottom, with Indianapolis coming out on top. What do they say? 8%, Matt, year-over-year rent growth.
Something like that, yeah.
It's right here. Yeah.
8.6, that's pretty good.
That's pretty good. Compared to down at Phoenix, which is really lagging. Looking at losses closer to negative, what is this, Matt? Like 2.5, 3%, something like that. Only Las Vegas and Phoenix are negative, though. I think that's important to note with markets like Austin, which has been, having some headwinds in terms of demand, a lot of new supply coming online. It's positive. 2.8% being the 10-year average.
Yeah, it's just because
over time as a good benchmark. So national average again, for context, but we should be seeing a little bit stronger. This part of the leasing season again. That's where we're waiting to see. Okay, when we get through April, really into May, we really should see some stronger numbers. And is it going to be positive at tepid? That's still not. That's fine. It's really not that bad relative to. It's not relative to again, average rent growth, but we have to be reminded we have some headwinds in the multifamily industry on the expense side. Yeah. So we're talking about revenue all day. Revenue is great. You can only cut so many expenses. You got to bring the revenue to make it work. But man, there are some costs that are hard to control.
That's what 2023 is for sure.
And if you've got some, if you've got costs that are very hard to control, like such as taxes or insurance, utilities you can control to an extent. Sometimes not all the time, to a degree. Payroll. Again, you can be smart and strategic, but you've got a lot of costs that are increasing. Yeah. And so, you might be having rents increase by, 3%, but if you got your expenses increasing by 5 or 6, it was not good. It's not, your margins are just getting, chopped pretty thin. Then the whole factor, if you're on a floating rate loan and your interest payments, your debt service payments are going up as well. You could have a great performing property. You'd be 100% occupied. You raise rents. Residents love you. Yeah, you've got great reviews. You even could be hitting all of your NOI targets. But your interest rate has doubled or tripled. Yeah. You're not cash flowing, or you're close to break even. Yeah. If everything's going right. Now, what if all your interest rates, tripled and things aren't going well? You're not 100% occupied. You haven't raised rents. Your expenses have gone up, but you went from 93, now you're at 85. You haven't been able to raise rents. You're having to give away concessions. People aren't paying rent.
It is.
Your pool's broken.
Yeah. It's hard to imagine that. why it's weird that we're not seeing more, because I just know, from like hearing the beginnings and ends of some of the conversations that like, and reading about it, obviously, is like, this is the time when belts are tightening, expenses are going up. And this new market report that I'll reference again, it has a good chart of expected rent growth and expected expense growth. And for most of America, the expenses are expected to grow more than the rents.
Well, Matt, if you're right, let's jump right to it.
Yeah, let's do it.
Because go check out the rest of the Yardi report. Sign up to the newsletter. Get all those reports and a lot more. GreatCapitalLLC.com/newsletter.